What if I told you that every time you chase price, you're falling for a carefully laid trap? Think about your last impulsive trade, the one where you couldn't resist jumping in as the candle stretched higher, only to watch the market snap back and punish your enthusiasm. This isn't just bad luck, it's the nature of liquidity, and you're not alone. Brian Shannon opens technical analysis using multiple timeframes with a direct confrontation of the universal trading mistake, chasing price into false liquidity. He warns, the majority of market participants are reactive, not proactive. They see movement and respond to it, but rarely do they understand what lies behind that movement. Your task, then, is to see through the mirage. Liquidity is the lifeblood of every trade. Buyers and sellers willing to transact at a price, but the illusion of liquidity is everywhere. When you see price moving fast, you assume there's depth behind it, but often you're just seeing a thin layer, liquidity that's been manufactured to trap you. This is what Shannon calls the liquidity mirage. The reality is harsher. Most retail traders are feeding the professionals, stepping into liquidity that's been staged just for them, and every time you chase, you become their liquidity. Ask yourself, have you ever broken your plan because of a single red candle, thinking it would keep falling, only for the price to reverse? That's you supplying liquidity to someone else's exit. This is the psychology of trading in its rawest form. The urge to act, the fear of missing out, the hope that this time will be different. But as Mark Douglas reminds us in Trading in the Zone, you're not trying to win every trade. Your job is to execute your plan with discipline, regardless of outcome. The best traders, Douglas insists, accept that markets are designed to deceive. So how do you resist the trap? The answer is simple but brutal. You must stop reacting to price and start analyzing liquidity across timeframes. You're not a hero, you're a detective, hunting for evidence, not acting on impulse. Shannon's message is clear. Stop being the liquidity and start seeing who's supplying it. Every trade, every breakout, every fake move. Ask yourself, who's on the other side? Is this move real? Or are you being lured in to provide the exit for someone else? Let's bring this to the ground. Picture the sharp rally after a prolonged sell-off. Volume surges, everyone rushes in. But the smart money? They're unloading, using your buying as their liquidity. The market is not a game of prediction. It's a game of reaction to liquidity flows. Shannon's charts are full of these examples. A classic. Price accelerates into resistance, volume spikes, then a violent reversal. The retail crowd is trapped, and the professionals collect their reward. Why do you keep falling for it? It's simple: emotion, impatience, and the myth that you must always be in the market. Bellafiore, in One Good Trade, drills this lesson. You don't need more trades. You need better trades. Your job isn't to outsmart every tick, but to recognize the liquidity landscape and wait for it to come to you. In this part, you've been warned. The trap of chasing price is everywhere, and it's fueled by your psychological blind spots. Liquidity is not just about volume or speed. It's about intent, structure, and time. Start thinking like a pro. Ask who needs you to take this trade and why. Your first step toward mastery is ruthless honesty. Admit that every time you chase, you're feeding someone else's edge. The journey continues. Next, you'll learn how to see the market through multiple lenses, revealing the true liquidity that's been hidden all along. The chase ends here, and a new level of awareness begins. Imagine looking at a chart, any chart, and realizing you're only seeing one angle of an entire landscape. That's what it feels like to trade from a single time frame. You see the 5-minute candle breaking out, or the daily chart flashing a reversal, and you think you know the whole story. But the reality, as Brian Shannon drills into your mindset, is that the market's true liquidity only emerges when you layer multiple timeframes on top of one another. If you're stuck in the habit of analyzing just one time frame, you're not seeing the real battles for liquidity. You're only catching the shadows of larger forces. So what does it mean to trade using multiple time frames? Shannon's core principle is this: each time frame tells a part of the liquidity story, but only their synthesis uncovers the true zones where traders, especially institutions, are poised to act. He writes, a trend on a shorter time frame often only represents a pullback within the larger context. If you ignore the bigger picture, you will find yourself entering at the worst possible moment, right as real liquidity vanishes. You start to understand. The 1 minute chart might show you a clean breakout, but if the 15-minute or the daily is running into heavy resistance, you're walking straight into a liquidity vacuum. Conversely, what feels like a hopeless chop on a small time frame can be the start of a powerful move on the larger scale, provided you learn to align your entries with higher time frame liquidity. This is where most traders get it wrong. They're lured into action by what looks obvious in the moment, blind to the fact that their time frame is just a small slice of a much bigger liquidity puzzle. Shannon's teaching echoes the wisdom of other masters, like Jared Tendler's The Mental Game of Trading. Your mind plays tricks on you when you look too closely or too narrowly. Zooming out often reveals where your risk really lies. Think about that. How often do you zoom in to find a trade instead of zooming out to see if the conditions are actually in your favor? In practical terms, this means you need a process. Start with the highest time frame that makes sense for your style, maybe the daily or the weekly. Mark the true swing highs and lows, the anchored VWAPs, the major support and resistance. These are the battlegrounds for institutional liquidity. Then drop down to your entry time frame, the hourly, the 15-minute, whatever suits your system. Now you're searching for price action that lines up with those higher time frame zones. Only then do you have the context to judge whether liquidity is real or just a fleeting mirage. This approach demands discipline. It means you're constantly asking, where are the real buyers and sellers? Are you about to trade into their waiting hands, or are you with them, using their liquidity to your advantage? The market's rhythm is fractal. Each move on one time frame contains echoes of bigger or smaller moves on others. Shannon's examples are relentless. A 5-minute reversal failing at a daily resistance. A breakout on the hourly exploding because it coincided with a weekly support reclaim. You start to feel the layers of liquidity, the push and pull that's invisible when you stick to a single lens. Compare this to Bellafiore's coaching at SMB. The best traders build their case across time frames. They don't marry one perspective. They hunt for alignment. The lesson? Context is everything. The more time frames you consult, the fewer surprises you face. You stop being prey to manufactured liquidity, and you begin to see the footprints of real money. In your trading journey, this is the moment where you break the habit of tunnel vision. You realize that time frames are not just technical settings, they're psychological windows into the actions of every participant, from the fastest scalper to the slowest fund manager. The market is a composite of their intentions, and only by weaving together their stories do you find where liquidity will truly matter. You don't need to predict the next move. You need to see the whole board. In the next part, you'll drill down into the classic battlegrounds, support and resistance, where time frames and liquidity collide. Your edge is clarity, and multiple time frames are your X-ray vision. You've started to see the market as a layered map, not just a single chart. Now it's time to zoom in on the pressure points where liquidity is truly magnetized, support and resistance. This isn't just about lines on a chart, it's about the psychology and battle for liquidity that erupts at these levels across all time frames. Brian Shannon insists, support and resistance aren't just places where price has turned before. They're zones where real money is committed, where trapped traders and fresh entrants collide. When you understand how these levels function on multiple time frames, you begin to see the invisible hands that shape every move. Think back to every time you've set a stop just below support or just above resistance. Why do those levels get run so often? Because they're liquidity magnets. Market makers and professionals know where the bulk of orders cluster. On the lower time frame, a breakout above resistance looks clean, but zoom out and it's often ramming straight into a higher time frame supply zone. That's not coincidence. That's where liquidity is thickest and where reversals and fakeouts breed. Support and resistance are dynamic, not static. A level that mattered on the hourly might be irrelevant on the daily, or vice versa. Shannon's examples show that the most powerful moves often happen when multiple time frames align. A 5-minute resistance stacked atop a 30-minute supply and a daily reversal. He calls these confluence zones, where liquidity pressure multiplies. Here, you see the real battle. Short-term traders trying to push through, long-term players looking to defend. The energy builds until someone gives in, and the move is explosive, either in continuation or a violent rejection. You must develop a habit. Whenever you mark a level, ask yourself, does this matter on the next higher time frame? Where are the real liquidity pools? Picture a tide of traders placing stops, limit orders, and market orders, each one a potential fuel source for the next move. When a support breaks, it's not just a technical event. It's a cascade of stops, a liquidity event that can spark a rapid move. Shannon highlights that the best traders anticipate these liquidity flushes, not by prediction, but by understanding where the herd is likely to act emotionally. Let's go deeper. You've seen the pattern. Price approaches resistance, volume increases, wicks appear. The majority tries to break through, but there's hidden selling on the tape, institutions offloading as retail tries to buy the breakout. A few candles later, price reverses hard, and you're left wondering why you chased it. Shannon's work exposes this trap. He writes, liquidity is a function of expectation and fear. Support and resistance are just expressions of crowd psychology at scale. When multiple timeframes overlap, the crowd's emotions and mistakes are magnified. Other trading psychologists echo this. Douglas warns, your stops are the market's targets. Tendler reminds you, discipline isn't about holding winners. It's about avoiding predictable losses where liquidity traps you. This is why you must learn to map out where the market is likely to search for liquidity, where the majority will be caught off guard. So how do you use this knowledge? Before every trade, identify support and resistance on at least 2 higher timeframes. Ask, is price approaching a zone where liquidity will be sucked up or unleashed? Wait for confirmation, a rejection, a clear shift in volume, or a fake breakout that signals the big players have finished collecting liquidity. Your edge comes from patience, from letting the market show its hand at these zones. This mindset shift transforms you from a reactive trader to a strategic operator. No more getting run over by false breakouts or breakdowns. You start to anticipate where moves will fail, where stops will be hunted, where liquidity will actually matter. In short, you begin to think like the professionals who set the traps, not the amateurs who fall for them. Next, you'll step inside the minds of traders, exploring how psychology and time-based traps create and destroy liquidity. Your awareness of these battlegrounds is your shield. Use it. You can spot the levels. You know where liquidity pools. But until you grasp the psychological machinery that drives traders into these zones, you're always a step behind. Brian Shannon draws a stark line. Market structure is not just a technical diagram. It's the collective psychology of every participant, playing out in real time. Every swing high, every double bottom, every failed breakout is a map of hope, fear, greed, and regret. You're not just reading charts, you're reading minds. Why do time-based traps work so well? Because the market is engineered to prey on emotion. Think of the last time you saw a textbook breakout on the 5-minute chart, but didn't notice it was running into major daily resistance. You joined the crowd, hoping for quick profits, only to watch the move stall and reverse. This is where Shannon's theory of time-based liquidity comes alive. Shorter timeframes are emotional timeframes, he notes. The longer you zoom in, the more you're trading against raw human reaction, not logic or strategy. You are caught in cycles. The faster your chart, the more likely you're swept up by impulsive trades, reacting to every tick, every fake out, every red or green candle that screams for attention. The market is a casino for the undisciplined, and its edge comes from manufacturing emotion-driven liquidity. Have you ever broken your plan because a 5-minute chart got loud? You're not alone. Douglas calls this the internal dialogue of disaster. That voice urging you to act now, before you miss out, before the move leaves you behind. Shannon's genius is showing how the trap is time-based. On the lower time frames, pros know you want action, so they build traps, spike the price, run the stops, create a surge of liquidity, then reverse. It's all psychology, weaponized by those who see the bigger picture. And the more time frames you watch, the more you spot these emotional fault lines. See how a 15-minute fakeout often unfolds right into a daily supply? It's no accident. It's the crowd moving as one, and the pros are ready. Jared Tendler, in his Mental Game, argues, your job isn't to kill emotion. It's to understand what emotion is telling you about risk. Think about that as you watch your heart race in a trade. The time-based trap isn't just on the chart, it's in your head. The longer you trade, the more you recognize that every breakout, every flush is a test of your ability to detach and observe. Bellafiore would add, you must become the hunter, not the hunted. The hunted chase, the hunter waits. How do you use this? Before every trade, pause. Zoom out. Ask, what emotional story is the market telling here? Is the move supported by higher timeframe structure, or is it just a lower timeframe shakeout, a bid to create liquidity for bigger players? The more you recognize these patterns, the less you'll be driven by the urge to act, and the more you'll wait for the crowd to supply the liquidity you need. The market is fractal, and so is its psychology. What looks like a panic on the 1-minute chart is just a blip on the daily. If you only focus on what's in front of you, you miss the deeper story, the true source of liquidity. The best traders, Shannon shows, are emotional contrarians. They wait for the crowd to act, then use the crowd's fear or greed as their entry. You profit from other traders' mistakes, not your own brilliance, he writes. This is your wake-up call. Stop being the emotional liquidity the market needs. See the time-based traps. Accept that your mind will urge you to chase, to panic, to trade just for the thrill of it. The professionals are counting on it. Your edge is awareness, seeing the structure and the psychology as one. In the next part, you'll learn how to pinpoint genuine liquidity zones, filtering out noise and focusing on where the real action happens. You're starting to understand that trading is less about prediction and more about finding where real liquidity waits. But here's the hard truth. Most traders confuse activity with liquidity. They chase what's moving instead of locating where institutional players are truly interested in taking positions or offloading risk. Brian Shannon offers you the keys to identify these genuine liquidity zones that are moving you from the role of liquidity provider to the role of liquidity hunter. So, what does a real liquidity zone look like? It's not just about a spike in volume or a sharp move. Those can be manufactured traps. Genuine liquidity zones are areas where multiple forces converge. Higher timeframe structure, clear support or resistance, and, crucially, the repeated presence of institutional-sized volume. When you see a level respected across timeframes and visited repeatedly, pay attention. That's where the big money cares, Shannon says. Let's get specific. Shannon recommends starting with the anchored VWAP, Volume Weighted Average Price, a tool that reveals where the average participant is positioned since a key event, an earnings release, a trend break, or a significant news catalyst. When price returns to an anchored VWAP and holds, it's a sign that institutional participants are defending their cost basis. Pair this with classic support and resistance, but only those confirmed on multiple timeframes. If the daily, hourly, and 15-minute all show reactions to the same level, you've found a liquidity zone that's not just retail noise, it's structural. He gives you the method. Look for clusters. Where do major swing highs and lows from different timeframes overlap? Where does the anchored VWAP line up with a prior supply or demand area? Shannon's charts are full of these hot zones, and you can feel the difference. Price stabs into these areas, volume swells, and reversals or continuations erupt. You're not hunting for random action. You're staking out the places where pros are likely to do business. Compare this with Mark Douglas's philosophy. Structure creates discipline. If you're trading off hunches, you're the one supplying the liquidity. This is where so many traders go wrong. They see an uptick in volume and mistake it for real interest, never realizing they're jumping into the shallow end while the big fish swim deeper. You must become a structuralist. If the zone isn't confirmed by multiple technical and volume cues, it's just noise. Now, think back to your own trades. How often did you mark a level only because it looked obvious in the last few candles? Did you confirm it on a higher time frame? Did you check if institutions might be defending it, or did you just want to be part of the action? The lesson is brutal, but necessary. Your job is to isolate only those zones where the odds of real liquidity, of actual market interest, are stacked in your favor. Let's tie this to practical action. Before you take a trade, map out the major anchored VWAPs from significant swing highs or lows, news events, or major market pivots. Layer these with support and resistance from at least 2 higher timeframes. Look for clusters, not single lines. Watch how price reacts on first approach. Are there aggressive rejections, or does price chop and absorb? Real liquidity often absorbs, then explodes. That's your clue. You are learning to think like an institution. You no longer chase every breakout or panic at every flush. You become patient, methodical, waiting for price to enter your zone and show its hand. Shannon's methods will save you from the churn and burn of amateur trading. As Bellafiore says, your edge comes from being selective. Good trades are found, not forced. In the next part, you'll discover how to use confluence across timeframes to time your entries, stacking probabilities, and removing more of the emotional triggers that cost traders so much money. Precision starts with location, but it's confirmed by timing. Stay sharp. This is where most traders start to separate from the herd. You've mapped your zones. You know where the big liquidity sits. But if you want to stop bleeding money on random entries, you need to master the art of timing by using confluence across timeframes. This is the difference between hoping a level holds and knowing you're stepping into a spot where multiple signals align and the odds are finally on your side. Brian Shannon is relentless on this point. Trade location means nothing without trade timing. The best traders wait for their timeframes to sync before acting. What does this mean for you in practice? First, you identify a genuine liquidity zone, maybe a cluster where the anchored VWAP, daily resistance, and a 15-minute swing high converge. Now, you don't just jump in. You wait for the lower time frame, the one you use for execution, to show evidence that liquidity is actually in play. Are there rejection wicks, volume spikes, failed breakdowns or breakouts that signal someone is absorbing or unloading size? These are your cues. As Shannon says, when the higher time frame gives you structure and the lower gives you entry, you're stacking the deck. Think about the last time you acted on a single candle or impulsive price movement. How often did it work out? When you add confluence, signals across timeframes, you're essentially reducing randomness. You're saying, I'll only step in when price, volume, and structure all agree. Bellafiore calls this hunting with a sniper's patience instead of a machine gun's panic. The majority of traders lose because they trade the right ideas at the wrong times. Confluence is the cure. Let's get concrete. Say you've marked a major support on the daily and you notice price is approaching that level. You drop down to the 15-minute and see a sharp flush into support, followed by heavy buying and a quick reclaim. Now you move to the 5-minute and see a base forming with a clear shift in the tape. This is not luck. This is time-based liquidity coming to life, and you're catching it as the crowd panics and the professionals quietly build positions. By waiting for all your signals to align, you dramatically increase your odds of catching a move with real follow-through. Shannon's method of multi-timeframe confluence is echoed by other pros. Mark Douglas teaches, your edge comes from waiting for alignment. When you act without it, you're just gambling. Jared Tendler pushes the discipline even further. Every time you skip a step in your process, you weaken your edge and empower your emotions. Confluence is not just a technical tool, it's a psychological anchor, forcing you to slow down, check your biases, and wait for the crowd to show their hand before you commit. In reality, this discipline to wait for confluence separates professional traders from the endless crowd of hopefuls. The pros know that liquidity zones are only opportunities when time and psychology are on their side. The rookie acts as soon as a price hits a line. The professional waits for the tape to confirm. Shannon's advice is ruthless. There's no prize for being early. You get paid for being right, not first. Take this lesson into your next session. Mark your higher time frame levels. Wait for your setup to appear on your execution time frame. Let volume, wicks, and price action show you that the crowd is trapped and the pros are stepping in. If the signals don't align, do nothing. Inaction is your most powerful weapon against emotional mistakes. You're no longer just identifying where liquidity matters. You're now acting only when every piece of the puzzle fits. In the next part, you'll learn how to spot and avoid the false breakouts and liquidity traps that have taken so many traders out of the game. Master this, and you're truly in control of your process. You've patiently waited for confluence, but the market has one last weapon, the false breakout, the engineered trap, the liquidity vacuum that destroys the undisciplined. Brian Shannon is blunt. Liquidity is always hunted. The market's job is to push price to where the most stops, limit orders, and fear-driven trades sit. If you're not careful, you'll become the liquidity that the pros seek to exploit. This is the graveyard of retail accounts. The fake move, the reversal, the emotional whipsaw that leaves you questioning your process and your confidence. Let's be honest. How many times have you seen a textbook breakout, clean level, rising volume, surging price, only for it to fail spectacularly within minutes? You're not alone. These are liquidity traps, and they're designed to flush out stops and capture eager late traders. Shannon writes, volume alone doesn't confirm a breakout. You need to see whether that volume is met with follow-through, or if it's just a rush of liquidity feeding a reversal. The professionals know exactly where the crowd will pile in, and they use that knowledge to stage their exits. Consider the anatomy of a false breakout. Price moves quickly above a well-defined resistance. Volume surges as breakout traders pile in. But almost instantly, the move stalls, wicks form, and the reversal slams back through the breakout level. This is not random. It's the market using your liquidity, your buy stops, your breakout entries to fuel the next move. It's psychological warfare. Mark Douglas reminds you, the market will do whatever it can to convince you you're right, then prove you wrong in the most expensive way possible. So how do you protect yourself? Shannon's answer is precise. Never judge a breakout on price alone. Look for confirmation. Does the breakout hold above the level and consolidate, or does it immediately reverse? Are you seeing sustained volume on the hold, or just an initial burst that quickly evaporates? The true breakout is supported by absorption, a steady grinding move as sellers fail to push price back, not a sharp spike and immediate collapse. If it looks too obvious, it probably is, Shannon warns. This is where your multi-timeframe process saves you. A breakout on the 5-minute might look convincing, but if the 30-minute or daily charts are approaching major resistance or anchored VWAP, the move is suspect. Bellafiore teaches, the best traders expect failure at obvious levels. They plan for the fake out. You need to be ready for price to overshoot, reverse, and then only after the weak hands are flushed, reclaim the level. That's the real entry. Not the first breakout, but the move after the trap is closed. Your discipline is everything here. Jared Tendler hammers this point. Every emotional trade is a victory for someone else's plan. When you chase, when you react to the market's engineered urgency, you're providing the liquidity that moves the market against you. Instead, be patient. Wait for the trap to spring, for the reversal to run its course, and for the tape to show that the crowd is done. Only then do you step in, calm, detached, and ready. The lesson is harsh but clear. If you're not actively avoiding liquidity traps, you're part of them. The market's false moves are invitations to act emotionally. Your job is to say no until the market proves its intent with structure, time, and confirmation. In the next section, you'll see how discipline isn't about fighting the market. It's about waiting for your moment, planning your trade, and letting the real liquidity come to you. The pros don't chase, and neither should you. You've seen the carnage that chasing false moves and liquidity traps can cause. Now comes the test of a true trader. The discipline to wait, to plan, and to align your actions with real liquidity rather than ego or impulse. Brian Shannon hammers this point again and again. Your job isn't to predict, it's to react to what the market is actually doing in real time around real liquidity. This discipline is what separates the amateur from the professional, and it is built on structure, planning, and absolute patience. Let's get honest. Most traders lose not because they lack technical skill, but because they lack the self-control to sit on their hands. They feel compelled to trade every setup, every move, every candle. But this compulsion is the market's greatest weapon against you. Shannon writes, discipline is the art of not trading when your edge isn't present. It's the ability to let mediocre setups pass so you're ready to act when true liquidity appears. The best in the business know this at a gut level. Trading is not about constant activity. It's about precision, selectivity, and timing. So how do you build discipline into your process? Start with a written plan, built around the liquidity zones and confluences you've already mapped. Every trade should have 3 elements. In Shannon's terms, the location, where is real liquidity? The confirmation, is there evidence the pros are stepping in? And the trigger, what price action will get you in and out? If any of these is missing, you don't trade. Period. No exceptions. As Douglas would say, The market doesn't owe you a trade. It will always be there tomorrow. Now, picture yourself watching price approach a critical zone. The volume is increasing, emotions are rising, and you feel the urge to jump in. This is where most traders fail. They abandon their plan and become the liquidity for someone else's strategy. Instead, your job is to pause, to ask, is my setup complete? Am I trading my plan or my emotions? Jared Tendler's voice should ring in your ears. Discipline is a muscle. Every time you say no to a subpar trade, you make it stronger. Bellafiore, in the playbook, drills this with his traders. You're paid for your patience, not your predictions. If you're bored, you're doing it right. It's not glamorous, but it's the only way to consistently align yourself with real liquidity and avoid the churn of emotional trading. Your edge comes from letting the market come to you, waiting for those moments when everything lines up and you have true asymmetric risk. Here's a practical exercise taken directly from Shannon's approach. For 1 week, log every trade you don't take. Track your reasons for passing, the setup, and what the market did afterward. You'll be shocked how much money you save and how your focus sharpens on only the best opportunities. You'll start to crave selectivity. This is the shift, the discipline that lets you operate like the institutions you're trying to follow. But this isn't just about missed trades. It's about emotional resilience. When you plan around liquidity and wait for confirmation, losses become data, not trauma. You're no longer battered by every red candle or false spike. You have a system, and the market's random noise can't break you. You accept that many days, your best move is to do nothing. So as you refine your approach, remember, discipline is the anchor that keeps you from drifting into bad trades. It's the gatekeeper of your edge. The next section will show you how to adapt to changing liquidity conditions, evolving your methods as the market itself shifts. But none of that matters unless you have the discipline to stick to your plan, no matter what. Markets are living, breathing organisms. Liquidity is never fixed, and what worked yesterday might not work today. If you cling to rigid strategies in a fluid environment, you will get run over. Brian Shannon's message is clear. Adapt or be left behind. The only constant in trading is change. The pros aren't married to their setups. They're married to their process of reading and reacting to evolving liquidity. The question isn't, does my system work? But is my system working right now in this liquidity regime? Think about the last time the market shifted character. Perhaps volatility dried up, or maybe the tape got violent after a news event. Did you keep trading the same patterns, hoping for old results? Or did you step back and observe, anchoring your view to what price and volume were telling you in real time? Shannon's tool of choice here is the anchored VWAP. He uses it to constantly measure where the average participant is underwater or in profit, recalibrating his bias as liquidity conditions change. When liquidity shifts, your first job is to acknowledge reality. Maybe the prior support zone has been blown out and is now acting as resistance. Maybe volume is drying up and you're getting chopped out of every trade. This is not the time to double down on old habits. Shannon writes, the market doesn't care about your comfort zone. It rewards those who move with it, not against it. That means being ruthless with your analysis. If the liquidity isn't there, you don't force a trade. If the anchored VWAP flips, your bias flips. You become adaptive, not predictive. This adaptability goes hand in hand with emotional flexibility. Mark Douglas preaches, the more you need the market to behave, the less it will. Most traders lose because they can't let go of yesterday's mindset. They want the market to conform to their rules, rather than adjusting their approach to match the new reality. You must detach from ego, detach from outcome, and instead get obsessed with observation. Shannon's practical tip. After every session, review how liquidity behaved. Where did it appear and vanish? Did your planned zones hold, or did new levels emerge? Adjust your plans and levels for the next day based on this analysis. Let's take a practical example. You've planned a long around support, but price rips through on heavy volume, anchored VWAP flips, and suddenly all your signals say trend day down. Do you stubbornly wait for the bounce? Or do you accept that liquidity has changed, anchor anew, and shift your bias? Bellafiore tells his traders, you get paid to adapt. If you can't, someone else will take your seat. The same applies to you. This also means knowing when not to trade. There will be days when liquidity evaporates. Summer Fridays, pre-holiday chop, or post-news paralysis. Shannon is ruthless. If the market isn't giving you opportunity, step aside. Capital preservation is a position. The discipline to wait for high-quality liquidity zones and the flexibility to walk away when they're gone will save you more money than any technical trick. Tendler brings it home. Adaptation is the highest trading skill. The best edge is knowing when your edge isn't present. So anchor your analysis in reality, not memory. Use tools like the anchored VWAP to keep your view fresh. Review, adapt, evolve. If you want longevity in this game, you must become a student of liquidity, always learning, always adjusting. Next, you'll see how losses and mistakes, especially those tied to liquidity, can be your greatest teachers if you have the humility to learn from them. Master this adaptability, and you'll stand where most traders fall. You've learned to adapt, but now comes the final frontier of trading mastery, transforming your mistakes, especially those tied to liquidity, into lessons that create a lasting edge. If you've survived the pain of being on the wrong side of a fake-out, a liquidity vacuum, or a misjudged regime shift, you already have the scars. Brian Shannon's work is brutally honest. Every loss contains information. The only traders who fail are the ones who refuse to learn. If you're willing to study your losses, not just your wins, you'll find that your progress accelerates in ways that no chart pattern or technical indicator alone can give you. Let's face it, every trader remembers their worst liquidity mistakes. The time you chased a breakout at daily resistance, only to get stopped out in a vicious reversal. Or when you averaged down as liquidity vanished, convinced the bounce was coming. These are painful memories, but they're gold mines of learning, if you approach them with humility instead of ego. Shannon advises keeping a detailed trading journal, not just to log trades, but to analyze why you took each trade, what the liquidity conditions were, what time frame traps caught you, and how your emotions influenced your decisions. Here's how you turn pain into progress. After each session, review your worst trades. Don't just note the loss, ask where liquidity was hiding. Did you chase into a vacuum, act on a single time frame, or ignore a signal that the crowd was being set up? Did you lose because of discipline, or did you misread the market's liquidity structure? This self-inquiry is your sharpest tool. Mark Douglas urges, if you want to grow, you must turn discomfort into data. Tendler adds, losses are feedback. If you take them personally, you lose twice. Don't just study your trades in isolation. Compare your journey to the process of pros like Bellafiore's traders, who debrief every single day, turning losses into fuel for improvement. Shannon insists you study the why behind every loss, not just the what. You'll find patterns. Maybe you're vulnerable to chasing when volatility spikes, or you overtrade when liquidity is thin. Once you know your triggers, you can plan against them. Transformation happens when you accept that losses are inevitable, but repeat mistakes are not. By owning your errors and focusing relentlessly on liquidity, you gain control over your process. The most impressive traders aren't those with perfect win rates. They're those who learn so completely from their mistakes that every loss brings them closer to real consistency. So, as you review your trading journey, recognize that true mastery is built in these moments of honest reflection. Shannon's final call to you: trading is about survival first, then profit. The more you learn from your scars, the longer you'll last, and the bigger your edge will become. You're now equipped with the psychological and technical tools to see the market through the lens of time, liquidity, and discipline. You know the traps, you know the escape routes. The next step is yours. Apply, adapt, and grow, one honest trade at a time. You've just journeyed through the unvarnished realities of trading as Brian Shannon presents them, moving far beyond charts and indicators into the heart of what really moves markets: liquidity, timeframes, and the psychology that binds them. Throughout this script, you've seen the dangers of chasing price, the necessity of multiple timeframe analysis, and the critical role of support, resistance, and confluence in uncovering real liquidity. You've explored the emotional and structural traps laid by professionals, and you've learned that discipline, adaptability, and a relentless willingness to study your mistakes are the real drivers of trading success. This isn't about prediction. It's about reacting intelligently, reading the ever-changing flows, and acting only when true opportunity emerges. As you move forward, remember, Your edge isn't found in a single setup or trick. It's forged through awareness, patience, and constant adaptation. So, what's next? Revisit your own trades with fresh eyes, identify the liquidity traps, anchor your charts to true zones, and start building the discipline to act only when the odds are in your favor. Begin by applying these lessons to one time frame, then expand. Read Shannon's chapters again, journal your process, and compare your experience to the teachings of Douglas, Tendler, and Bellafiore. Every mistake is a teacher. Every pause a sign of growth. Stay vigilant, stay humble, and remember, the market rewards those who adapt and endure. If this breakdown resonated with you, like, comment, and subscribe for more deep dives into trading psychology and strategy. Share your hardest lesson in the comments. Let's grow together as traders.